Hello, everyone, and welcome to today's webinar, the CRE Lending Comeback, Growth Returns, but Risk Remains. I'm Anna Griggs, Director of Marketing at the Coleman Report, and I'm going to go over just a few logistics before we get started. Throughout the webinar, we'll be bringing up a couple of live poll questions that we'd love for you to participate in. Usually those should pop up on the middle of your screen, but if not, you can find them in the Microsoft Teams chat box. And then you're also welcome to submit questions at any time using that same chat box. Our presenters love to get questions, and our panel will address them as they fit in naturally throughout the conversation. This session is being recorded and will be uploaded to Coleman Report's YouTube channel, so don't worry if you miss anything. You can always go back and find it. And now I'm going to go ahead into it and introduce our expert panel. I'll keep it brief as you'll be hearing plenty from them shortly. But today we are joined by Tim Mazzetti, Vice Chairman CRE at Citizens AMC, Charles Krawitz, Senior Vice President and Head of Commercial Lending at Alliant Credit Union, Brad Salzer, President of Lindell Capital, and John Winnick, CEO of Clark Street Capital, who is graciously co-hosting this with us today. Thank you everyone who is on joining us live, and a big thank you to our outstanding panelists. John, I'm going to pass it over to you to get us started.
Anna, thank you for the introduction. This is the third time we've brought this group back, and I will have no issues getting them to talk. And maybe some issues getting them to shut up, but it'll be once again a great group. We're going to start with an overview presentation that actually came predominantly from Citus AMC. Apologize for Anna's mispronouncing there. This first chart just kind of shows you kind of where economic uncertainty is, and clearly from the chart, since COVID-19, there's been a lot of uncertainty. We all know investors don't like uncertainty. And so certainly there's been a lot of that of late. Charles, I mean, does this type of uncertainty make it more unlikely to make loans, or how has that affected your originations?
John, in the past, I have been one to kind of run into the storm. During the great financial crisis, as capital retreated, I was able to pick up significantly more appealing lending opportunities. Same thing during COVID. Just always having the fortitude and running into the storm. But this time, it feels different. And I have found myself filled with dread and trepidations. And I have not been as aggressive as I have been in the past. And perhaps I need to go see a therapist about this. But there are opportunities out there, and I am trying to talk myself into having the fortitude to say, this too shall pass, and that we will see numbers that are more aligned with the center line on this graph than these massive peaks above that.
Hey, Charles, why the shift this time around?
I think just the unprecedented nature of the uncertainty. It's, being whipsawed back and forth by tariffs, no tariffs, war, no war. There's a lot going on, and there's a lot, and maybe it's the media hyping things in a way that they've never hyped before. But that certainly has caused plenty of sleepless nights and grabbing my phone throughout the night and checking headlines to see what kind of tumult there is in the world.
Well, Charles, John just sent me the name of a couple of therapists here. Since you're both in Chicago, I think it could be
Excellent.
useful.
This kind of reminds me of a Buffalo. These times remind me of a Buffalo Springfield song called "For What It's Worth." I think some of the older folks on the phone or on the webinar are probably familiar with it, but here's a little sampling of it.
Oh, he's actually going to play it.
I'm glad we're not singing it.
Oh, God. Yeah, well.
So that sums it up. There's something happening here. What it is ain't exactly clear.
Yeah. Excellent. Let's go to the next.
With the other crises, I was able to see my way through, to envision what the other side looked like and kind of when we would get to the other side. It's hard to do that now.
Yeah. I mean, one thing I'm kind of hearing from banks is they're concerned about tariffs. They're concerned about what DOGE has been doing, but they're not exactly sure what it means yet. And certainly things like tariffs could help steel companies, for example, but hurt OEMs. So there's just a lot of confusion of what this all means. As we go to the different food groups of commercial real estate, if we look at apartments, the long trend line on vacancies and rent growth, along with the forecasts, you could see some pretty dramatic rent growth in multifamily that pretty much peaked around 2022. And now you're basically at flat to negative rent growth. My guess is if you look from a regional standpoint, you're seeing some differences. Brad, my understanding is you're the Jamie Dimon of Tampa. Certainly seeing some softness in multifamily in the Southeast. Any color on that from your perspective?
Of course I have color, because I have color on everything. I want to first talk about Charles. No, but from COVID, my therapist can see you remotely from Tampa. So we're all bidding for you to get therapy. I think is fascinating. What's interesting about this slide to me, John, is that for so long, multifamily was the darling of the asset class, and now, and we shouldn't be surprised, because really real estate is so much of a supply and demand game. And as everybody, particularly in the Smile states, the Sun Belt, overbuilt naturally, especially with the aggressive rent growth that we were underwriting to, we would expect some softness. Demographically, I think multifamily is going to be fine. But more interestingly, or as interestingly, just before today's webinar, I went to my friend Fred, and I hope everybody on this call has played around with Fred, the St. Louis Federal Reserve kind of research tool. And I just put in there commercial real estate prices for the United States. And I look at it, and we are well below the fourth quarter of 2009 in the drop of value. Now, maybe a disproportionate share of that is in the office sector, but I'm here to tell you that values are down. And that's reasonable, given that interest rates were so low for so long, cap rates were so low, and the trajectory for real estate values was diagonal from the end of the great financial crisis, when rates dropped, until only recently. And I'm not sure we've had the correction that I think is really coming. And interestingly, to Charles' earlier point, I don't think it's the media, Charles, right now. I think what you're feeling, the whipsaw, the confusion, is very real for all of us. And in my business, in the distressed world and in the underbelly of real estate finance, acquiring mortgage debt from lenders that need to delever, it creates a great opportunity for us. And I would submit to the audience that I'm due as a note buyer. It's time that these values corrected a little bit.
And Brad, at the end of the day, it's probably I let too many other voices get into my head. Too many podcasts from Moody's, from TREP, from Lightbox, and others, and perhaps in prior crises, maybe I was just less educated and willing to take the plunge. But I do know fundamentally that apartments come out the other side of this and do quite nicely. I know that we Americans just love stuff, and there'll be an insatiable need for places to put that stuff. And if it's not in our apartment, it's going to be in a self-storage facility. So, I know that comes out the other side of any downturn strong. I know that industrial will prevail. Some question marks around retail and office, but there are asset classes that Alliant Credit Union lends in and plays very strongly in. And maybe I just need to keep some of these other voices out of my head and realize that we are lending over 5 years, sometimes over 10 years, and that the in the moment noise does not really matter.
Project specific. Let's go to the next slide on office fundamentals. We've all seen this. I mean, one thing I just point out in the office market is if you look at the return to office numbers that Castle puts out, I think they're running at about 54% usage. That number has been pretty flat for a couple years. So RTO has been somewhat overhyped. Companies just aren't laying people off that are high performers and won't go back to the office. But you could see the slow return offices driving vacancies. This prediction shows vacancies kind of petering out maybe next year, this year. Obviously, rent growth has been very flat in that segment, but they do predict it'll start to turn positive in 2028. Going over to industrial, which I believe is next. Industrial, one thing I'd point out with industrial is there's virtually no CMBS delinquencies of industrial. There's no sign of any trouble in that space yet, but certainly we could see some issues there. And then finally, I believe we have retail, and in the retail market, again, vacancies have been steady, slight uptick during COVID. But one thing you've seen is some slight rent growth and some predictions for some higher rent growth in retail going forward. Next slide regarding financing. I thought this was very interesting. These are, I don't know if these rates are outdated yet, Tim. I know this was from the end of March, but
right.
That sounds about right. 6.5% for commercial, 5.7 multifamily. Charles, your color on this? Is this kind of what you're seeing out there, or is this a little?
Yeah, I think multifamily is a little bit higher. If you take out the agencies.
Okay.
Then you just look at the kind of non-subsidized market, if you will.
Got it. And then go to deal volume. I mean, this is very interesting, and you could say this in a lot of sectors. Deal volume has not been great overall. I think there were some projections that this year would see this big uptick in commercial real estate transactions. It hasn't really happened yet. There's still a lot of money on the sidelines. My suspicion here, and I'm sure Tim and Brad, you have some thoughts, is there's still a bid-ask spread, and there's certainly sellers who think rates are to come down and they'll get a better price.
Yeah, it was my research team that put all these together. We went through this presentation last week, so I had some questions. Some of this, John, is cyclical, right? So you can see that, the end of the first quarter and into the second quarter tends to be slower than obviously summer or end of year. But go back to that first slide of uncertainty and whether Charles needs therapy or not is definitely affecting investors across the board, whether buyers, sellers, or lenders, as to where to put their money and whether to sit on the sidelines right now and hopefully hope for some clarity. My two big questions for the rest of this year is, will there continue to be a soft landing and potentially a slight downturn, or could we actually get a recession? That will have obviously a significant impact, and Brad might make your day, certainly from a distress standpoint. And then the second question that I have is, where will interest rates shake out? I think, and we're going to get to this question later in the session, John, but I can't see the Feds moving tomorrow. And so will they move later in the year, in the fall, the end of the year? That will obviously have, if they do lower rates, have a positive impact on the lending side.
Yeah. Last slide, delinquencies. The top chart would be, looks like that's commercial real estate loans from banks. And the bottom is your CMBS delinquencies. One thing we've been pointing out for a while is if you really, the only apples to apples comparison you can do between banks and CMBS is multifamily because of the unfortunate limited number of call report codes. And, the CMBS delinquency, as I recall, is in the mid fours on multifamily, and the banks are in the mid, like 50, 60 basis points. So at least now, there's a big divergence between CMBS delinquencies and bank delinquencies. I suspect some of that is based on quality. Tim, you have some thoughts on that. Why is there still this dichotomy between bank delinquencies and CMBS?
I think, and we spoke about this in our pre-call, I think two basic reasons. First of all, banks have a lot more flexibility. You touched on it. I do believe that banks and life insurance companies tend to have a tighter credit box or a little better managed credit box as opposed to, a whole bunch of different originators throwing spaghetti on the wall and getting it securitized and then walking away because they sell the loan into the trust. The other issue with CMBS, and that naturally leads us to, and I know CMBS people hate when I say this, but CMBS has kind of become the lender of last resort, both in terms of the structure. REMIC structures are very borrower unfriendly, and the master servicers, I'm sorry to say, don't help. And so you're going to have typically slightly better quality loans that are done by banks. They also have more flexibility on the workout side and restructure side. They can play footsies a little bit and play with whether a loan is fully delinquent and or modified and performing, whereas in CMBS, the line is much, much tightly drawn. And so you're gonna see a natural higher rate of delinquency for CMBS than you will balance sheet lenders in general.
Yeah. Another factor as well is I think when the banks shifted from once a TDR, always a TDR to the CECL rules, a bank can take a loan that's going to be troubled, modify it, and then upgrade it in 13 months. So the bank data, you're hiding a lot of restructured loans now that we've gone to CECL. But let's head over to a poll question, which I think is a great topic regarding the sentiment of our audience. Are you bullish, bearish, or neutral about commercial real estate? Actually, that's a wrong question. If we could pull up the okay. Well, sorry, it's the bullish or bearish on about bullish, bearish, or neutral on commercial real estate. Oh, Alana pulls that up.
I don't have that, but I can pull it together right now.
Okay. All right. While we're waiting for that poll question, you mentioned CMBS flexibility. Take something like office, Tim. So if we conclude that this office building isn't going to be an office building, we need to convert it to residential. Can CMBS as a servicer work with that borrower, or is it just pay me off and then we'll talk?
Yeah, very, very difficult to do so, John, because of the REMIC structure and the inability of the master or the special servicer to be able to raise additional capital. And that's been Office's biggest hit for as long as I've been in the business, right? It is extremely capital intensive, and it's just become more so. If you're not the Class A or the best building in the submarket or the second best building, and even so, you're going to have to spend a lot of money on TIs, leasing commissions, and keeping your building, attractive to potential tenants, you're in trouble. And so what we're seeing, John, is in our special servicing, a lot of borrowers, and certainly in CMBS, will just decide to walk away. They're not going to throw good money after bad. The structure is not, again, easily available to make a rehab out of an office building. And so, again, and that also ties into the previous slide. It's delinquencies and defaults are much heavier on that side of the fence.
Yeah.
And
Yeah.
when an office building goes, when the borrower sponsor decides to give those keys back in a CMBS structure, how long before that property becomes fee title and ready to go get recirculated in the market? I mean, it's a long time, isn't it, in the securitized world for that product to come back online?
Brad, it's no different than what you would face as a balance sheet lender or anything else. It depends on the jurisdictions. So obviously a non-judicial state, Texas, Arizona, a number of others, you literally can get title in 30 days. You start moving up the East Coast or California or certain other states that are judicial foreclosure states. I mean, we've had situations like Connecticut, New York, what have you, New Jersey. We could be in litigation, even without bankruptcy, for months, if not even years. And so that's always been a challenge on the workout side, no matter which side of the fence you're sitting on.
I used to joke that
Tim and Brad, we talked about return to office earlier. In the context of whether it's 2 days or 5 days, the space requirements probably have bottomed out, right? You need to, even if you're in for 2 days, you want everyone there for 2 days. And so you have to have enough space to house everyone, regardless of that space maybe sitting empty for 3 days. So does that imply that offices have perhaps bottomed out and we'll start seeing an uptick? Some of them have converted, some of them have been torn down.
No, very good point. And there was an article this morning in Wall Street Journal talking about certainly the New York market, the number of office buildings that are tied, or lined up for conversion and or being torn down and redeveloped, which is obviously going to help. And the New York market, office market, is actually doing quite well. The buildings that are well positioned are actually seeing pickups in occupancy and even rent growth. And obviously the Class A buildings in New York are killing it. I mean, we're talking unbelievable rents. But to answer your question, that's a very good point, Charles. What we're seeing is, and again, that's what's happened over 22, 23, 24, where there was a lot of kick the can down the road. Why are you going to try to take a hit now when potentially feds might lower rates? Office is obviously hitting bottom. There's probably some light at the end of the tunnel. Let's give someone an extra time to see what happens in another 6 months, 12 months, 18 months. What is interesting, and we talked about this maturity wall. We're going to have, I think, a lot more pain coming down the road second half of this year and into 26 and 27, certainly for office, because there is no end in sight, right? You've hit bottom. If the Fed doesn't significantly lower rates, where are you going to go? And so I think we're going to see more delinquencies, Brad. I think you're going to see some good opportunities on the distress side. I think it's going to pick up.
And Brad, if the Fed, does this magical rate lowering thing, for how long does the market care about that? Or is the market going to, is the evil eye of Sauron going to be focused on the $36 trillion worth of debt and some of the structural problems with the American economy, and we're going to see rates go up despite any Fed action?
Well, the big question, a lot for me to think about there. First of all, I think we've got huge inflationary problems, which are going to keep the rate higher for longer, whether we want it or not. I think we in the lending and real estate community are like, the dog getting his treat. We are just desperate for those rates to come down. And it's as much as a psychological issue as it is anything. But when John had the slide up there showing where the rates are are today. I mean, I would tell you, and I perhaps am the grandfather on this call, despite being Jamie Dimon on my street in Tampa, rates are not that bad. Rates are at a 5.89, at a 6.5. Historically speaking, they're not that bad. I think we became totally spoiled and entitled for 14.2 years when they were at 3. And so now it's getting our head around and underwriting to yesterday's pricing and loan at a different price and deleveraging a little bit, or more equity's got to come in to fill the gap. And, whether they believe that it's coming and there's a reason to live or not is what we're going to find out as this plays out.
Yeah. We do have the poll question back. Not surprising. 72% were neutral about commercial real estate, which kind of echoes what Charles said to start out. Slightly more were bearish. More than 2 times people were bearish than bullish. So the sentiment is predominantly neutral. Thoughts on that, gentlemen?
I like neutral. I think that's better than the alternative. I mean, in this market with all the uncertainty. So for right now, I think staying the course we don't have a choice. We got to live with what we got.
Yeah, neutral so long as we stay out of a recession.
Yeah. So John, neutral kind of pervasively across the entire space, but real estate has always been a very local business. And I think, I know all of us that are speaking, as well as probably everyone who's listening in, are adept at finding individualized opportunities. And no one is probably exposed to this generic real estate writ large.
Yeah. I mean, I remember talking to a bank CEO in Chicago about office, and he said, look, it's project specific. We look at the project. We don't have, we have a macro view, but we don't let that overwhelm us. Let's talk about CRE underwriting. So the most recent Federal Reserve Loan Officer Survey showed in April, 9% of banks were tightening lending standards. It was 7 in January, 20% in April, 67% in April 2023. That's probably when the liquidity crisis was. So it does seem that there's a little more tightening than loosening on commercial real estate. Charles, what are you seeing, and how are you underwriting CRE loans today? And are you tightening versus a year ago?
No, I would say we are just trying to be smart, trying to find those individual opportunities where there's multiple demand drivers for the asset, where we think the market is not being overwhelmed with supply, or that there'll be sufficient absorption to pick up any of the supply that is still coming online. And fortunately or unfortunately, labor costs are high, material costs are high, regulatory environment is overbearing, and there's not a lot of new supply coming online. So it's allowing existing real estate to kind of catch up, which is good to continue to experience rental growth and increases in occupancy. So we're being selective, but we've always been selective. We'll put out a little bit over $500 million this year, which is about the number we put out last year as well. I would like more of that money to be put out in back leverage to private debt funds. We've played in that space for 7 or 8 years now, and we have close to 15 different relationships. And I thought private debt funds were going to be the heroes of 2025, going up higher in the capital stack, using their ownership expertise and operational acumen to be able to be discerning and find opportunities. But that space, unfortunately, has been a little bit slower than one would think. And maybe it's because life insurance companies are out there being aggressive. The CMBS market is out there being aggressive. And maybe it's a third or fourth quarter play when these other sources of capital have kind of met their allocations, or for whatever reason have pulled back from the market a little bit.
Tim and Brad, what are you seeing? You think banks are tightening, or maybe it's banks are tightening or tight, but private credit and CMBS is loosening? Thoughts on that?
Yep, I think you just said it, John. I think that Fed report talked about bank credit officers. I do think banks have tightened because we're seeing it as private, credit. I have more deals right now than I could possibly have time to fund. I just can't get to them all. Whether they close or not, you'll never know. But the opportunities are there for us. And maybe to Charles's point, everybody's waiting a little bit to determine whether or not, they want to pay the cost of private credit or have to pay the cost,
or
which is going to be higher than bank. They're forced to. So they're waiting on the sidelines a little bit to see what happens. But the banks, I do think, are very conservative right now, is my sense, and others are picking up the slack.
Yeah, I just came back from the CREFC annual conference in New York last week. One of the issues, and I think, Charles, you and I spoke about this, there is so much capital out there, okay? A lot of capital is sitting out there, and some of it does have to get deployed. Not everyone can be patient. And so I think you're running into that a little bit, Charles, where, there's a lot of aggressive money that needs to get put out. A number of folks that I spoke to said, they're having strong years so far and expect to continue to put money out.
Yeah. It's funny you mentioned that. I was having lunch last week with a Chicago bank, and they lost a loan on an office building to another party, which seems incredible. Basic terms were they were proposing a 50% advance on a 50% occupied downtown office building, and the private lender came in at 65% advance, a shorter term, more fees, and a bigger spread, 400 basis points. I mean, I think that's a good example that banks and private credit are warming up a little bit to office. Thoughts, gentlemen?
Wow, Chicago. I'm sorry, no disrespect, John and Charles, but the Chicago office market is toxic. I mean, it's one of the worst in the country. Downtown LA, San Francisco's coming back with AI. New York, as I said, is actually going quite well. But Chicago has got some real problems, I think, for an office.
And I'm going to shift from bashing Chicago, and I'll move to office instead. I just closed on an office deal, suburban office deal in Atlanta. The issue I've got with office, and Tim alluded to this earlier, pre-COVID office bothered me because of the tenant improvement dollars that I needed to have for it, and the commissions on a 10-year deal when I wasn't sure the tenant would be there 10 years. So that's my bigger issue with office. I mean, yes, I do think we've got the RTO issue, which I think, Charles, may be hitting bottom. Relative to your point earlier, but my issue is just the expense of the office generally.
Brad, you are spot on. I worked for an office leasing firm very early in my career, and I saw that firsthand, where the capital outlays for tenant improvement and leasing commission dollars, it was onerous, and the returns were dubious. And because of that experience, Alliant Credit Union maxed out with a whopping 3% of our book exposed to office. And I'm glad that I've kept in mind all these years, what you just so nicely articulated.
Well, hey, Charles, I had a question for you, not to put you on the spot, but if you look across your portfolio, what is your biggest area of pain?
So it's when we've gone a little bit off center and gotten a little bit too adventuresome. So we have historically been very knowledgeable and very effective at lending on manufactured housing, mobile home parks. That led us into the RV space, which was, closely adjacent to it. And we started to get into the RV space by doing properties that had some permanent homes on them, as well as some transient RV space. And then, of course, that led to, I'm a little embarrassed to say it, glamping, doing a glamping community. So kind of getting a little bit full of yourself and incrementally convincing yourself that you can move into a space that you really fundamentally don't know anything about. So glamping has been a painful lesson for us. Office, kind of a mixed bag. Things looked really, really ugly on our few office deals. Tenants vacated, and then tenants are coming back saying, oh, we went from 70,000 feet down to 7,000 square feet because, it's a different world. Oh, wait, sorry. Can we take back, half of that space and bring it up to 35,000 square feet? So seeing a lot of that. We have a deal in Portland that we thought was just going to be an absolute train wreck. And lo and behold, occupancies have rebounded there as well. And I know that market in particular has gotten some really bad headlines. So I think, office is probably, if you're a total contrarian, go office,
Yeah, well, usually when you're a contrarian, you can see some of the best deals. We have a poll question, which I think some of you already answered. What is your attitude towards new non-owner occupied office loans today? This is for lenders. We are actively making new office loans. We make them to select clients. We will not consider an office loan under any circumstance. Let's give a second for that to
Interesting. There's no one actively making office loans.
Charles, it's funny that you say that about office. And you in Chicago, I wonder what Sam Zell would be saying right now relative to office.
Yeah, so Brad, at one point in my career, I did briefly work for Sam, and that perhaps allowed me to prosper during different crises. And I just got to keep reminding myself of that, now.
No wonder you need therapy.
Oh, no, I think you're being too subtle.
Yeah.
His book, Are You Being Too Subtle?
Well, Charles, answering the poll question, it sounds like really nobody's bragging about making new office loans. Everyone is select clients. Surprisingly, only 22% will not consider an office loan under any circumstances. So, that's certainly encouraging. Charles, I know you work with a lot of private lenders. You do some financing for them. You mentioned volume was a little soft. What's your view on private credit? I know there's some concerns that it's getting so big, it could blow up the economy. What are your thoughts?
I think it's great. I think it's fantastic. I think in commercial real estate, there are a lot of folks that have deep ownership and operational expertise, and they're bringing that to the lending side of the equation. I think being in partnership with regulated financial institutions is a great win-win combination, that these private lenders are having to be mindful of the regulatory environment that their back leverage partners need to be compliant with, and it's worked out well. We have learned from these private lenders that have been able to specialize in construction and bridge loans and have deep market expertise in ways that we really can't. And at the same time, they have learned from us about how to dig deeply into guarantors and their other holdings and how those activities may impact the particular loan in question. So it's been a great partnership for us, and I really welcome private credit into the commercial real estate lending space. I can't speak to it outside of CRE, but within CRE, it's been a great source of capital. Some of them are more cavalier and will pay the price for being cavalier. Hey, I don't need an appraisal. I don't need an environmental. I'm a real estate guy. I'm not going to let an appraiser tell me what value is. I know what value is. Well, fine, but they're not going to find a regulated financial institution to give them back leverage and help them lower their cost of capital, if they are obdurate with respect to things of that nature.
Right, and Tim?
Well, I would tell you as a private credit guy who does back lever, Charles, I think that was a great answer. And I think you really defined the difference and the dichotomy between us, where I am very CRE centric and it's about the asset, versus perhaps the banking world, which is more credit oriented and guarantor oriented. And I don't mean to be cavalier, but if it ain't going to work out, I will take your real estate, and I will gladly take your real estate, because I feel like I've lent at a price that's going to allow me to come out the other end probably better off, but with a different risk profile.
Yeah. I am a huge supporter of private equity, but then I successfully built several companies on that bet that I made literally 20 something years ago. I made a strategic bet that the regulated financial institutions, banks, insurance companies would be losing market share to private equity. This goes back literally back in the early 2000s. And lo and behold, that's exactly what has happened, and it's continuing to happen. And while I've got nothing against regulated financial institutions, but I think you hit the nail on the head, because that box is very difficult to play in sometimes with a complex asset class like commercial real estate.
Yeah.
And John, the really neat thing about, private debt funds is it allows everyone to kind of pick their poison. They have different risk tolerances than I have. But we can both be involved in the same transaction, with very kind of segmented risk profiles.
Well, they're a lot more focused. But you could also say if you're focused, you're not diversified. So I suspect it really depends on the private credit lender. And there are probably some very good ones, and there are probably some very bad ones. And, the bad ones won't do so well. Tim, question for you. I mean, we've been talking about extending and pretending for a while. Are people getting tired of this? Do you see servicers and your clients and banks stopping this, or is it kind of just continuing?
Yeah, I think we, at least looking at it from a special servicer standpoint, expect to be busier in the second half of this year and then through 26 and 27, especially on the office side, because I think we have hit bottom.
Yeah.
But there is no more rope there. You've got to either come to the table with additional capital. And again, office is so capital intensive that if you can't come to the table with additional capital, we need to take the asset back, get it sold out into the market and into someone's hand at a different basis that can make sense out of the investment, or, redevelop it. But again, while the Wall Street Journal front page article about office and redevelopment, it's still a very small percentage of the total office space, market across the country. So like retail and what happened in the disruption in retail, it will take time for that office to get absorbed and come back into what I would call a good balance.
Yeah.
John, I think the notion of extend and pretend is, really, it's a headline thing. I think most lenders have taken a give and get approach to troubled loans. And to Tim's point, borrowers are increasingly not in a position to give anymore. And so they're not going to get anymore. And
Right.
Properties, will unfortunately be taken back and put onto the marketplace.
Yeah.
I do think it's interesting, John. Maybe last year at this time we were talking about survive till 25. I mean, we have survived till 25. I mean, I wouldn't say that there's a bloodbath out there. I think we've perhaps retracted and we're worried about a falling knife, but we survived till 25. Maybe we'll fix it in 26.
Yeah.
Good one.
He's got it. Hospitality.
I knew AI had its uses, Brad.
Yeah, that's right. I'm the AI guy right here.
What's got ChatGPT working
What's
right
AI?
Hospitality. I always look at Las Vegas as being the most interesting hospitality market because, you'll see the Flamingo for $1,500 a night during ICSC, and you'll see it for $30 a night, perhaps tonight. I have seen, I did see an anecdotal report on Instagram about a guy that covers Las Vegas. He said free parking is coming back. Hotels are now doing $100 daily food credits and so on. Are we seeing some softness in hospitality? And are there some issues with franchises and PIP issues in hospitality?
Absolutely. That is a property type we're watching very carefully. And a lot of, again, it goes back to what I said earlier. If we go into a recession, look, the consumer's already cutting back. Right. I think, Brad, you sent out a survey or a chart yesterday that showed the increase in consumer defaults. And we're stressed. I mean, inflation is real. I mean, the cost of groceries and travel, it's the increases are huge. And I think you're going to start seeing the impact on the average person cutting back on their vacations, cutting back on their travel. And certainly it's happening, with what's going on here. A lot of people aren't traveling from Europe and elsewhere to the United States, and just because of policies and a situation like that. So hospitality is one that we're watching very carefully.
And I am too, but Tim, it's interesting. On this morning's news, they were talking about Europe, Barcelona, I think in particular, and they are so heavily touristed right now that they're trying to keep people away from there. They're discouraging it, which is interesting. And I wonder if some of that isn't the sentiment, which is hard to bake in for us numbers guy, the sentiment post-COVID that, by gosh, nothing's going to keep me from enjoying my life and spending money. And that's why we're seeing the credit card debt go up. I mean, we got accustomed to so much with rates low that now that we're having to pay more for gas and groceries, we're just putting it on our credit card. But I'm confused, and I'm very cautious about hospitality, have been, but yet I'm often wrong, and I certainly seem to be wrong right now on hospitality. They're spending and they're paying $1,000 a night for these places. I mean, it's just crazy. And maybe it's the haves and have-nots, which could be another webinar topic someday, but maybe that's getting wider.
And Charles, me, I'm not lending directly on hospitality, but I'm lending on hospitality through some very, very select, private debt funds. I love working with the likes of Peachtree, who knows that space inside and out, and they can pick, winners far better than I could. And so that's been fantastic for us.
Yeah. There's a lot of chatter about AI. And, when you look at commercial real estate, office comes to mind, how AI could disrupt it. Certainly AI could disrupt multifamily if job growth shrinks. But so far, I mean, what are you seeing with AI and commercial real estate? What impact are you seeing out there?
Well, we're spending a huge amount of time and effort focused on AI. We service across the world, both in Europe and here in the US, including special servicing. I think the number is 450 billion. I mean, those are big numbers. And if you think just in the US book, we're pushing 220 billion, and the vast majority of our portfolio is short-term floating rate, high touch, higher yield, higher risk, right? So bridge, ground up construction, heavy rehab, mezz, pref equity, and all sorts of, leverage, loans on loans, repo lines, CLOs, etc. AI could absolutely transform our business because the amount of heavy lifting that our people have to do, for example, on almost all of our bridge loans, we're doing what we call QARs, quarterly asset reports. And those are heavy, heavy lifting. You're basically re-underwriting the sponsor's original business plan every quarter, because that's the risk, right? Our rents, are they leasing their space at the original business plan rents? Is the market moving on you? Are the rents going down? Is the market getting soft? Yada, yada. Just imagine what AI could do. Right now, we have people, and that's the other big issue, human error. We've got human beings manually entering this data and trying to get it done as soon after quarter end. AI could be absolutely transformative. Apply that to underwriting, apply that to originations, apply that to risk. The question is going to be, in my view, adoption. Right now, Excel is still the prevailing technology used by just about every one of us in our businesses. AI is going to replace that, but humans don't like change. And so, in my view, it's not just getting the right technology, but then implementing it and getting adoption, which is going to take some time.
Tim, you're going to have AI writing up your quarterly assessments, and then are you going to have AI reviewing those and deciding whether it's acceptable?
Great question, Charles. The one thing I've learned, and I've been spending a lot of time on AI just because a couple of friends of mine are actually launching true AI, and I'm not talking about OCR or machine learning or what have you. I'm talking COBOL and large language models, and basically ingesting huge amounts of data on the front end, organizing it, and then presenting it back. There is no context. Okay. And it's really interesting because we've got a lot of people in India who basically do a lot of manual entry and initial underwriting. You can tell the difference between someone who underwrites alone in the United States and someone who's doing it in India. No disrespect. They just don't have dirty boots on the ground. They don't understand. They have no nuance. And so to answer your question, that piece of the puzzle still needs to exist. And then a big word of caution. You better make sure that the source data is true and accurate. Garbage in, garbage out. If that is not the case, what do they call it? Obviously, that's the extreme case. ChatGPT, Grok, Claude, all the different ones that are out there. They're getting all their data from the internet, for Christ's sake. No wonder they have hallucinations. Hell, I'll have hallucinations. But my point is, you have to make sure that the source data is accurate and true.
But how is it? I mean, I guess that my deeper question is, how does it impact commercial real estate beyond office? I mean, Brad,
it's going to take a while. It's going to take a while. But look, there's no doubt in my mind that the young, and look, again, another headline, there's like a 6% rate of unemployment for people coming out of college right now. Why? Look at that uncertainty chart. Companies are not hiring right now. They may not be firing, but they're not hiring because they don't know what the future holds. You bring in AI to the equation that's basically going to I could replace 8 or 10 people doing manual data entry with one who's going to review it and quality control it with a more senior level. What's going to happen to those people? They're going to have to be retrained, or they need to be doing something else.
John, think about logistics and how AI might be able to reshape the use of warehouses in a way that we can't, conceive currently, to optimize the physical environment in different ways.
Yeah. While I'll go to the next question, if you have any questions, now's a good time to send them in the meeting chat, and we'll certainly take those. Let's stay with Tim for a minute. It does seem like more and more banks are getting out of servicing. Wells exited most of their mortgage servicing to Trimont. What's going on with the servicing space? It certainly seems like it's consolidating.
Well, it's an interesting question. Wells Fargo, from what I understand, again, it's secondhand here, so I wasn't part of the transaction. But from what I understand, the servicing business, and quite large, Wells, I think, had about $600 billion. Wells and Midland are the two largest in terms of commercial real estate servicing. If you include all of their agency business, their balance sheet loans, and then all the CMBS, they were the leading master servicer in the industry. They sold basically the CMBS book. They kept the agency business, which is obviously a strategic lending business for them, very customer driven, and obviously the balance sheet book is going to stay with them. So to answer your question, what we're seeing, and same thing happened on the residential side, John. If you go back 15, 20 years, all the major servicers in residential were banks. Nowadays, they're all privately held.
Yeah.
I think what's happening again is a disruption. Was not a strategic business for Wells. They had 1,000 people, doing the servicing for that $400 billion book. And they probably figured it was a good way to exit and, reduce headcount, which banks are always looking at ways of reducing headcount. So Will something happen to KeyBank or Midland? I don't know. I haven't heard anything, but it's certainly a possibility as these banks continue to look at their business plan and their strategy.
Brad, do you think the Fed's going to cut rates this week, and should they?
No and no. Move on. No, I really don't think they should. I don't think the good news is the market's already priced into it. I'm still concerned about inflationary issues. Maybe it's because I don't like the price of my groceries right now, but we'll see. And we keep watching the 10-year. I mean, I don't know that a Fed market move is going to be that big a deal right now anyway. So.
Agree.
Yeah. That
John,
doesn't mean
I know
still not waiting for it in the fall.
Yeah.
Well,
I know KeyBank, Mark Zandi of I think he's Moody's said that inflation could hit the 4s due to these trade issues. We haven't obviously seen that yet. The readings have been fairly minor. But what are you folks seeing with inflation?
It could hit. I'm more worried about unemployment picking up and a potential recession. And then obviously the Fed's going to have to weigh the lesser of evils. Do I, keep rates high to continue to battle inflation, or do I try to stop the bleeding if the economy starts headed towards a recession?
Equals stagflation, which I'm most concerned that that's where we could be headed.
Yeah. Low growth with high inflation.
I'm most bearish about the residential market with respect to commercial real estate, because I don't think people realize how much speculation is going on in the 1 to 4 space. You have things like occupancy fraud, Airbnb, the weekend seminar, home flipping crowd. Charles, I think you mentioned an anecdote. You went to one of these things once, and definitely seems like there's a lot of euphoria in the entry-level segment of commercial real estate.
Yeah, the resi market is not doing too well right now. Too many sellers, not enough buyers because they can't afford it, quite frankly.
Yeah. While we're talking, I got a question from Alex. With rates rising as rapidly as did over the past couple of years, how frequently have you seen sponsors walk from deals versus going back to their equity to right-size their debt?
It's a good question, and I mean that's what we're faced with now. And right now, I believe that extended pretend is what's allowed them to survive till 25. What happens next? And really, I think the covenant defaults we can look the other way a little easier, particularly if payments are being made. I think the maturity issue is really what's going to separate the wheat from the chaff. And so we'll see what happens now as these loans start maturing. I don't know if I answered the question, Alex, but right now they've been able to limp along, and now I think the rubber's going to hit the road.
Yeah, sounds like our question was answered. Well, we're at 12:59. It's been once again a spirited debate.
Hey,
you,
John, I did want you go real quickly going back to AI. I did ask AI whether it would be beneficial for me to be on this webinar or not, and it was yes. The answer was yes. I should be on this webinar.
Are you seeing the AI summaries of the action items that somehow we have here? Brad has some action items, and I just thought it was interesting that somehow AI is providing a transcript of this and giving us things to do. Brad, you're supposed to explore opportunities in the distressed CRE market, okay?
All right, I'll do it. I'll report back immediately.
Excellent. Well, this is a fantastic group. We plan on doing this every 6 months, so stay tuned for our future webinars. Anna, do you want to close us out?
Yeah, I mean, you caught the question that I saw. You guys did an excellent job. Of course, if anybody has any questions, they can reach out to us at any time and we'll pass them over to you guys. But past that, you guys did great, and we look forward to seeing you back in 6 months.
See you all. Good seeing you, John. Thank you.
Thanks, everybody.
Thank you,
Thanks,
and
everyone.
that concludes today's webinar.
Thanks.
Thank you, everyone.
Thanks for joining.
Bye.
Bye.